Hey guys, Forrest Mead here with Keller Williams, your Central Florida realtor. In this video, I'm going to talk to you about the different down payment options that exist for first-time homebuyers, as well as sort of just the misconceptions about how much money does it take down to buy a house. Check it out. I'm here to talk to you about a subject that's important to me as your Central Florida and Orlando area realtor. Born and raised in the area, and this is a question that comes up a lot, especially with the number of young people that are trying to become first-time homebuyers. I get questions all the time at open houses, door knocking, my Facebook page, from close friends of mine that are curious about home ownership, from sign calls, people calling in on properties, and they're curious, what does it cost me to buy this house? The number one myth I'm going to knock out right now, right out of the way, get it out, done with it. It does not take 20% down to buy a house. It does not. So if that is the illusion you have in your head that you don't have 40, 50, 60 grand lying around, great. Most people don't, and they still own a house. I'll tell you some of the things you can do to get into a house for a much more cost-effective price point that will actually work for a lot of you. I actually had a client recently who was considering re-signing a lease or potentially moving to a new rental property. Between first, last, and deposit, he was looking at needing probably somewhere in the neighborhood of like $5-6 grand for roughly $1,800 to $2,000 a month rental property. Instead, he bought his own home for about $4,500 total out of pocket. That is an incredible thing for him. Not only does he have his own home, not only was it in great shape with brand new roof, newer kitchen, all that kind of fun stuff, he also spent less money than renting. So let's talk about the loan programs that work for most first-time home buyers. The most common one is FHA. So FHA is a federally backed and insured home loan, typically targeted for people that don't have perfect debt-to-income ratios, perfect credit scores, and very well maybe buying their first home, trying to start building wealth instead of making their landlord wealthy. You need 3.5% of the purchase price down with an FHA loan. There are some down payment assistance programs that can help mitigate that slightly, but understand that any down payment assistance or reduced down payment program on an FHA loan is going to typically cost you a slightly worse interest rate because the lender has to get their money somewhere. The folks lending you money, it's how they make money. There's the old adage, if it sounds too good to be true, it probably is. If you hear no closing costs or super low closing costs, the money is coming from somewhere. And that's fine because you have your job, you get paid, they have their job, they get paid. In addition to that 3.5% down, you're going to need somewhere between 3.5% and 4.5% on average of closing costs. I tell folks typically 4%. So if you're doing some math on average there, that's 3.5% for your down payment, 4% towards your closing costs. Roughly 7.5% in total. So in a $200,000 sort of average 3-bedroom, 2-bathroom home here in Central Florida, about $15,000 in total. Still seems like a big sum of money. Totally get it, totally understand. Understand too that you can ask both your lender and the seller of your home to contribute towards your down payment and closing costs. Your lender's going to do it with an adjustment of your interest rate, still better than paying rent, and your payment will still be reasonable, but they will adjust it there. The seller understand that if you ask the seller, let's say, for 3% back and closing costs to cover a vast majority of them, you're offering them 3% less on whatever number you offer. So it's typically best to come in with a pretty strong offer when you want to finance those closing costs in, but it also reduces your cash out of pocket. I had a gentleman who called on a property we had just the other day who's renting in the area for about $1,400 or $1,500 a month for a similar type of home that we have for sale. If he were to buy it, he would need about 5 or 6 months of rent, which he has in savings ready to go, and he'd be paying about a $900 mortgage compared to the $1,400 he's paying in rent. As soon as I told him that, the first question he had was, where can I get qualified? Where can I change my living situation so that I can get into my own place and just own it, make it mine, and stop paying so much in rent? Immediately, within a few minutes of that phone call, I had a group text going with one of my lenders to connect him to him, to get the ball rolling, to make him a homeowner very soon. The second type of financing that does work for some first-time home buyers is called USDA. So USDA, you've got to be a little more out in the country. It has to be in a fairly rural and agricultural area, which there are a surprising number that are still right near civilization. And for those loan programs, you need 0% down. That's a big deal. You heard that, 0. Now you will be carrying a 100% loan-to-value ratio loan, which means it's going to be a little riskier for the bank. It's going to have to be a nice, clean property, go through a good inspection, be in good shape so the bank's investment is protected. It also means it's pretty difficult to sell one of those, typically for a couple of years, because you don't start off with any sunk equity. You're not making the down payment. You can if you want, you're just not obligated to. The third type, for any of you veterans out there, we thank you for your service, is a VA loan. And I'm sure most veterans that are watching already know what a VA loan is, but it's a phenomenal option for our military to get into a house also for 0 down. The fourth type, if you're, let's say you've been working and living maybe in a downtown area, you've got a good paying job and you want to get the ball rolling, would be to go with conventional financing. The advantage to conventional financing is that if you have a good credit score and you're able to put a little more down, you can have very low or eliminate what's called mortgage insurance. So on most loan types where you have less than 20% equity in your home, you're going to pay a monthly premium of mortgage insurance. Mortgage insurance is not a bad thing, but it doesn't always fall off unless you're under a conventional loan and you get to 20% equity. That does not mean you pay 20% of your loan back. That means the bank has a 20% equity position, which means the appreciation and improvements to the property, you can and often do eliminate your mortgage insurance premium before you've actually made 20% of your payments, before you're 6 years into a 30-year loan. That's an important deal because that mortgage insurance for some people can be over $100 a month, over $1,000 a year savings once you get to that equity position. So it's super, super important to make sure that if you're considering going for a loan type where you think you'll be in the property for a while, you've got good credit, you've got more income, you can put a little more down, consider conventional. There's also what I would call a bit of a myth. The conventional finance buyers are always a better option for a seller than FHA, VA, or USDA. However, there is the perception that if you're going conventional, you might be viewed as a slightly stronger buyer. So there is an advantage to conventional in that regard as well. With the other types of loans, that mortgage insurance doesn't go away unless you refinance out of it, which you can certainly do if you need to. But if you've got the ability, talk to a lender. They've all got pros and cons. If you've got a lower credit score, you're going to put less down, and you've got a higher debt-to-income ratio, the mortgage insurance on a conventional is going to be higher than the government-mandated mortgage insurance on an FHA loan because the government is insuring it and absorbing some of that risk. It's not going to the open market. So that talks a little bit about down payment. In future videos, we'll talk about what your whole payment looks like, and that includes principal, interest, taxes, insurance, any mortgage insurance, HOA fees, CDDs, all that fun stuff, to get a much better idea of what your payment actually costs in terms of buying a house. It's important to understand right out of the gate, you don't need 20% down, you only need 3.5%, if that. If you're buying out in the country, you can go 0 down. If you're a veteran, you can go 0 down. And if you have a little more money, you can also look at conventional financing at anywhere from 3 to 20%. I would typically tell you, put down what you're comfortable with if you choose to go that conventional route, but you've definitely got options available to you. If you have more questions, you're curious about what your financing options might look like, message me or call me, text me, email me. My phone number is 407-719-0684. My email is forrestmead@kw.com. That's forrestmead@kw.com. If you like that video and you want more content like that, make sure to hit the subscribe button. Invite friends, family, coworkers to do the same, as well as hit the notification button so that every time I upload more content, you know it's there and can continue your home buying and real estate education. If you're moving to Florida, thinking about buying a house, selling a house, things you're curious about, put it in the comments. I'd be happy to reply to it, as well as make a video for you so that we can answer your questions as well. I'm here for you. Look forward to making your home buying dreams reality.